You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program where we help you, the busy financial advisor or asset manager, learn how you can implement options in your clients' portfolios. It also help to keep you abreast on the latest developments in the world of options because you know you're busy. You're out there doing your job. You're meeting with clients, getting to know them, managing their portfolios. You know, time to keep up on the latest developments, research, studies, events, all that kind of fun stuff coming from the world of options and derivatives. So we do it for you. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. We have a fun show for you today, helping me break down this crazy world of options and advisors and everything therein. First off, let's go out to the quiet, the tranquil shores of New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Amberson, welcome back to the program. How are things in the land of New Hampshire? One state adjacent to the options mecca that is Maine. It's
going great. Yeah, options mecca, Maine. Everyone thinks that's the first thing people think about. I'm just proud to be on. Chris Hausman goes out to the RMC in Munich and posts on LinkedIn and gets 15 times more likes and comments than I do. So I'm feeling a little inadequate here out in New Hampshire, Mark.
Well, you need a sweet title, maybe, like the Director of Risk, and then you too can be awash in the love and the regard of the masses. Of course, I'm talking about the Director of Risk himself, Mr. Chris Hausman, also the portfolio manager over there at SWAN Global Investments. We just call him the Director of Risk. Mr. Risk Director, welcome back to the program, sir. How was your recent foray across the pond?
It was a good visit, and it's always good to be back while I'm not dodging storms. And I think it's a quality versus quantity thing, because if you'll know, I post one thing like every 5 years. So if you spread that out, you've got much more kudos on all of your posts there, man.
There could be something to that volume perspective. But speaking of that event, let's get to it. Let's break it all down with a little bit of the old buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. Like the man said, this is the portion of the show where we try to keep you abreast on the latest developments in the world of options and derivatives. It doesn't get more inside baseball these days than an event like the Risk Management Conference. It's effectively a gathering of a lot of like-minded professionals, usually on the asset management, oftentimes a growing number on the advisory side as well, many of whom are coming to share knowledge or perhaps learn about how to use options to manage risk across a broad spectrum of portfolios. And our own Director of Risk, Mr. Chris Hausman, just returned from it. It was over there in Munich, Germany. They have multiple events. They have one in Asia. They, of course, have the flagship event here in the U.S., and then they have a European version from which Chris just came back. So, Chris, first off, a little birdie whispered in my ear that you may have been speaking over there. So why don't you break down what you talked about over there at RMC, and then maybe break down the event for our audience and maybe any interesting takeaways or conversations or talks that you heard while you were there.
Yeah, so I did speak, and I kind of took on the role of, what I've noticed by attending these conferences is that you're going to get a wide array of knowledge as far as options are concerned. And I can understand it can kind of be intimidating for people that are just getting into it. And I think this is one of the issues with all these conferences is because they're diving in over the last few years, as you know, they've been diving into heavy volatility and selling certain strategies, et cetera, et cetera. And I think the mix was much better this time. And I kind of took it upon myself to say, okay, look, I'm going to be the kind of kindergarten version, if you will, for these conferences and just make sure that people who are kind of new, provide us some type of foundation for them so that they can enjoy the next 2.5 days of the conference. So I was the second speaker and the timing was right. And I did this with, a gentleman from Neuberger Berman, and he talked about the SIBO indices. But what I did is I looked at, the Morningstar options-based category, something we're pretty familiar with. We talk about it all the time here. I just gave an introduction on that because it is a relatively new category starting in 2016. And there are 160 funds in there, but if you take out all the investor classes, you're really looking at only 60 different funds. And we've said it again here a lot of times. Well, it started off as option writing. It's options-based now, but the reality is you've got 3 different components in there. You've got the hedgers, the income producers, and the alpha traders, which are the anything goes strategies. And then what I did is we talked about basic strategies like what hedgers do, what you can do if you're on the hedging front, what the income strategies do, and then what the alpha strategies do. And at the end, where the real good meat was at the end of the presentation was I broke down every single fund in the group. So basically, we had some slides that just showed, okay, if you had to categorize the group, what are they doing? Are they net short call spreads, net short put spreads, unit breakdown? The majority of the funds are using shorting premium to either offset hedging costs, or that's just their mandate if they're an income fund. So I think it was the first time, presenting all the kind of the detailed analysis of what's really going in this group, because as everybody knows, the three of us know that these funds are different. They've got different roles, objectives, risks, and people need to understand how they're going to work, especially if you're going to put them inside of a portfolio. As far as the overall conference is concerned, the content was very spread out. So, there's always going to be something on talking about the index products that SIBO has, right? Because pension funds, advisors, consultants, they all need to benchmark against something, especially if you're going to start in the options world. And then there's always the volatility talk, systematic strategies, the challenges behind systematic strategies lately. I think some of the interesting things is that, a lot of models are being challenged because we are, especially in Europe, and, I think we focus so much on our domestic markets that we tend to lose focus or sight of what's going on across the pond. There are challenges modeling negative interest rates, okay? We don't deal with that here, but they're dealing with that over there. U.S. trading and the way we trade versus the way they trade is different. They've always been more volatility-centric, meaning everything is delta hedged. They quote things in vol points, whereas we'll trade outrights all the time here. We'll take delta because we have different objectives. So it's interesting to compare and contrast the different styles of trading. But, definitely the same type of issues are out there. Is like, how do we, get these strategies onto Main Street and teach people that, they can use covered calls or they can use, put right type index products if that risk reward fits them, and et cetera. So it's the same theme among all the conferences. Like, we got to get the word out there that these are good tools to use in portfolios. They can help to hedge if that's what you want to do. They can help to add income if that's what they want to do, if you want to do. And there's strategies that'll try to take advantage of any market anomaly if that's what you're looking for as well.
Yeah, I often joke that this conference, I've been to a few. I've never been to the European version, but I often joke that this conference effectively boils down to everyone seemed to collectively awaken to the joy of selling puts. There's so many presentations on how selling pick your poison, 3%, 5%, 7% out of the money S&P puts or put spreads or some variation therein, perhaps a ratio, is the newfound panacea to all the ills of your portfolio, and it outperforms X, Y, and Z. It's funny, everything old is new again. They use the vernacular of harvesting the risk premium to make it sound a little sexier. Was that very much a theme at the conference again this year, Chris? Everyone waking up to the joy of selling puts?
No, absolutely not. I think they've taken a big step away from that. Again, the short volatility argument is still there. There's still people that, historically, it has succeeded over the last 10 years especially. I'm not going to deny that. But, I pointed out to people, okay, is this really a delta or, if you're in the stock world, a beta thing? Are we making money because there really is, we're harvesting, especially in the short put right? Yes, there's some risk premium there. I'm not saying there isn't, but in a 10-year bull market, sure, that strategy is going to work. So I think there was definitely some caution out there to where the debate was, is it getting to be a crowded trade? And depends, sell-siders said no, buy-siders are starting to say kind of, sort of, or it's not as juicy as it once was. Now, just keep in mind for our listeners, there's multiple ways to harvest this risk premium of being delta neutral or doing outrights or other types of strategies. So it really depends on what the overall objective is inside that overall portfolio. But just to sum that up, yes, I agree with you 100%. The conferences, like every other presentation, was sell puts, sell puts, sell puts, and now all of a sudden it's like, okay, because of 2018. 2019 is not. It's been kind of challenging, not like a 2018, but it definitely isn't like prior years where that was the trade to make and it was always making money. I think it's people are having a little bit more difficult time, especially modeling volatility. We've talked about skew. What's happening in skew during sell-offs nowadays? That used to not happen. A lot of talk about selling upside calls. That there's just theoretically it's a really hard trade to make money off, and the counter's been happening over the last few years where upside calls have been monetizing. So to sell calls on the upside has been very challenging. And I think that was the overall theme, is like, yes, there's still risk premium out there. Yes, it can add value to portfolio, but you have to be able to look for it in different ways.
Matt, I know you've been to an RMC or two. In fact, I think I ran into you at the most recent one in the U.S. here. What are your thoughts on this conference and the various approaches it takes to the option space and to the quote-unquote harvesting of the risk premium, sir?
Yeah, I actually have been to a few of both types, the domestic RMCs and the European RMCs. And the European RMCs I thought were a little bit more technical. And I was impressed and depressed, because I'm conservative. I want to talk a little bit about hedging. And so everyone knows how expensive it is to hedge. And it seems like what I saw at the RMC European ones were very creative ways to hedge equity downside exposure with non-equity related things. I don't know if Chris saw any of that there, but people were making these correlations, and I remember Osh used to have some funny correlation stories, but they would, the VIX is scary enough for me, but they were going off on real estate and credit spreads and interest rate things that, who knows if they're going to hold up. And then, and just to talk a little bit about the way the skew looks on these market downturns. I mean, sometimes it steepens and sometimes it gets shallow. I mean, I'm looking at a graph right now that we've recently released of all of our slope metrics and such. We have a data API, but also now we're graphing it and. Sometimes the slope is steep and sometimes it isn't steep. So, I mean, and if you had some type of a skew product to hedge your equity exposure, it might work in some environments and it might not work in others. I was curious if Chris saw any of these kind of tail hedging with creative instruments, Chris.
No, actually, I did not. The talk really is still more about they would rather not hedge, or hedging has to be tactical. Yes, it's expensive and can be a drag on a portfolio over time. So the lean still is to sell puts, but they didn't get so esoteric with a lot of these different products and trying to hedge out all these different types of risk. I think at the end of the day, it was really the challenge is, hey, negative interest rates, that's messing up our models, our global models. The dispersion over the last few years between value and growth. But risk premium is still out there, not as healthy as it used to be a few years ago. I mean, those were the major themes.
One of the other things I've noticed about RMC, it's been an interesting thing to me to watch the evolution of the audience and how disparate it is and how much it varies by geography. You get the U.S.-based events. You have a lot of the U.S. audiences, the RIAs, the pension funds, the asset managers. Many of them are very new to the options and derivative space, and they have very basic questions. How can I hedge? What does this mean? How much will this cost me? Oh, what's this short put thing? This sounds fascinating. So basic concepts like that. I know the U.S. event for many years had a core track of just basic options education just to meet that need. And certainly we agree with that. We do a lot of that here on the program as well. But then you start seeing they'll always have a panel in the U.S. event, at least, of the Canadian pension funds, and they're up there talking about using variance swaps versus OTC volatility, and they're talking about next level degrees of volatility. And of course, I remember from my days in the SPX, whenever that phone would ring down there was a strong chance that there was a French accent on the other side of that phone. So there's always, for reasons that are still a mystery to me, there's always been a very strong penetration in the SPX and indeed VIX from the Central European crowd as well. So I'm curious, Chris, did you notice a bit of a different audience at this event? Were they maybe more on the uptake when it comes to things like volatility, or was it more in line with what you see in the U.S. type events? Any interesting nuggets or takeaways from who attended this thing?
No, it's what Matt said earlier. It is a different crowd. Geographically, the event was in Germany, so the majority of people were from that region. But yeah, there were United Kingdom represented, Switzerland, France, were the main, if I had to divide up the attendees by geography. But yes, I agree with Matt 100%. They seem to be a little bit more technical. They like to see formulas on slides. I think if you put a formula on a slide here in a U.S. conference, most people are going to run to run to the door or just gloss over it. They really want to know how a model works and what formulas are going into it. And like I said, I mean, remember, they're trying to squeeze, the way they trade volatility a little bit different than the way we trade volatility, and that's what it comes down to. But they've been doing this for longer than and I'm making a general statement here because they went electronic many, many years before we went electronic here in the U.S., right? We still had open outcry, 15, 20 years more than they really did. So their style of trading has changed, and their philosophy towards risk has changed. They hate delta. Everything's delta hedged. We're not. They think we're kind of like Cowboys when we come in and trade naked puts and naked calls. and I think that's just the way they've been trading for years, as opposed to the way we've been trading with a different type of mentality, because we're still have that get into the pit and yell and scream and we'll take risk, but we're meeting our objectives for our portfolio. And that's the difference, in my opinion.
Did you hear anything about factors? I mean, I've never heard so much about factors as the last couple of weeks here, especially with momentum, the momentum factor getting whacked in the value in terms of value. And there are other factors as well, growth and dividends and size and those, even volatility is a factor now. Did they talk about that at all? Because I've been inundated with that here, and we've been doing more back tests with using different ETFs underlying and comparing one ETF to another ETF. Did you hear much about factors over there, Chris?
Yeah, I did. The whole globalization, they said, kind of ended 10 years ago, and what's happened is that the United States consumer has gotten stronger vis-a-vis the rest of the world, right? They're dealing with negative interest rates. We are not. They've been teetering. All their economies are teetering in and out of potential recession more than what we've been doing. And so the U.S. consumer basically in U.S. dollar terms has gotten stronger, and that U.S. consumer really wants to own what kind of stock out there. They want to own Amazon and Netflix and all these growth type stocks. So you've had this where growth has really outperformed value over the last 10 years. But I agree with you again 100%. I'm starting to hear the growth versus value has gotten so out of line right now that I think people are starting to put the bet the other way now that it's going to start to normalize again. But there was also some discussion that, that the discrepancy that we've had between growth and value over the last 10 years or so could continue another 2 or 3 years. So it really depends. Is Trump going to be reelected? Is he going to keep talking the market up and make, that will be a factor to where, that could happen. But these things take years to unwind. And I think, I read the other day, it could be one of the next great bubbles, right? The whole growth versus value, and that's about to turn the other way at some point. But it takes some time with that kind of trade. The other thing interesting to hear was how they moaned and groaned about the Trump tweets, that has made their life extremely difficult over there because of the overnight gaps that we've been experiencing here in 2019. I think they've been bigger since the gaps that we have overnight this year have been larger or more of them since the great financial crisis. So that's when their markets are open, right? And that's making them, at least we're sleeping through it. And I'm like, oh, hey, SPOOs are unchanged, but the reality is that they move 20, 30 handles overnight. So they're having to deal with that real time, whereas opposed where we're just sleeping through it and waking up in the morning and like, hey, nothing happened.
I guess they're not fans over there of the Valfefe index, the newly coined index from JP Morgan, where they attempt to model and codify the volatility derived from those Trump tweets. Well, where there has been volatility as well is out there in the land of earnings. It's kind of coming to an end now, but we're getting ready, Matt. The cycle, it pretty much never ends. You guys at ORATS never get to sleep because once it winds down, it pretty much gets ready to start all over again. But you were talking on the last show, and I think we have a little bit more data now, which is kind of interesting. I was looking at your season report before the show, and it is kind of fascinating. I do, by the way, recommend listeners, if you haven't checked out the season report. It's kind of a new edition, the earnings season report. It breaks down every week by what was expected versus what was actually delivered. And if you look at that, you check it out, theoptionsider.com, or head on over to orats.com, ORATS.com, to find it for yourself. And it's got some interesting nuggets. Matt, what's been surprising you this quarter? I know last time you said it's kind of one of the more surprising cycles since you've been tracking this stuff. Is that still the case?
Yeah, this last earnings was exhausting, and it was.
I thought you sounded a little tired.
Yeah, it was an outlier on many different fronts, and yeah, thanks. So we put this seasonality together. We number the weeks, and 1 through 6 is kind of typical to get we capture about 96% of the reporting firms, and then we could boil it down to what's the implied move that we're seeing currently going out those 6 weeks, and then what has been the past move, so we could see what the valuation is looking like. So, in this earnings season, it started off, a little bit higher than other earnings seasons, but then, we had so much volatility, with the tweets and with, various other things that it just caused the earnings to go crazy. And so owners of earnings straddles weren't doing so great they did okay the first week, but then that valuation came down, and that's when we had the earnings Mageddon, the huge week, the third week, where we've never seen returns of 35%, and we had that. And then, and the earnings continued. Then the implied moves went up to match up a little bit, but they still surpassed it. And then the last week, it really quieted down, but the implied moves were still way up there. So we had the opposite. We had the biggest loser that we've seen, almost 20% losers for owners of options. So it was quite a crazy season that we had this last season. And we're preparing for the next one. We did another study just to corroborate what what these numbers are showing. So we actually went in and traded on thousands of earnings symbols, going back to 2007. And to see, where our win rates matching up with the win rates that we're seeing, and they are. So the win rates are only about 40% for owners of straddles, but on balance, the owners of straddles are making a little bit more money than the sellers. So, and they're both negative in our back test because of the. We charge a little slippage and some commissions, so it's not like there's a free lunch out here, but you have to really pick your spots. But, this is an interesting time around earnings, and it's interesting not only to look at how earnings valuations have changed since 2007, but also how we track how the earnings reporters vary from the week 1 through 6. So, obviously the bigger stocks are reporting early because they have the technology to get their financials in order quickly. And, those stocks are the ones that actually have the lowest returns. And then it starts to get a little volatile around the middle to the late. And then the last one, the stragglers, are usually overvalued and not returning as much. So again, take a look at it's kind of hard to explain in this table, but we have it color coded up on Option Insider blog, so you could check it out over there. But it's we're ready for the next one, Mark, and I'm not expecting and nor should anyone expect this crazy of an outcome this time, Mark.
That'll be interesting. I'd say you could rest up, sir, but we got more show to do. It is time to keep on rolling right on into Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. The name says it all here. So we pretty much approach usually a basic options concept or strategy or technique and explain how you can implement it in your clients' portfolios. And we thought, we were recording this today on the 18th of September, so it is Fed Day. In fact, the Fed just announced they are cutting for a quarter point, signaling at least one more rate cut to come this year. So rates under a little bit of downward pressure right now. We know for a lot of you out there, a lot of the RIAs and asset managers, income is kind of job one. It's really one of the big things you guys use options for. And so we thought this might be a good time to maybe revisit that, because as rates continue to go down, the traditional low-hanging fruit methods of going out there and trying to find and harvest income for your portfolio will become much more challenging. So as a result, people tend to turn to our neck of the woods. They tend to come into the options fold. They come to the dark side because they want to generate some income. So it's a good time to do a nice little refresher on some of the most popular ways people utilize options to generate income. Let's start with the tried and true, the gold standard, kind of one of, if not I think the data goes back and forth, but I think for most of the data I've seen of late, this is pretty much the number one. If not number one, it's number two, very close, in terms of the use case for options with advisors. That is indeed the covered call. Very basic position. Of course, I encourage you to check out the archives of this show. We've done several deep dives just into that position, so I encourage you to go back if you're not familiar with it. But in a nutshell, of course, the basic position is you own a long underlying position. Could be an index, could be an individual equity, could even be a future or something like that if you're on the more sophisticated side of the spectrum. And then you write typically an out-of-the-money call. You know, I say typically because where that call is that you're writing is the subject of an intense amount of scrutiny and debate, and varies depending on your needs and your goals and your outlook for the underlying, and also your risk tolerance and your viewpoint on what the most effective way to write calls is. And there are many studies. Again, you can head over to our friends there. Our buddy Eric couldn't make it on the show today. He's not dodging a hurricane, thankfully, today, but he is traveling yet again. Optionseducation.org, a good place for a lot of data on covered call writing and the efficacy therein of different approaches. But the nice thing about this, of course, is it's a very simple strategy at the end of the day. A lot of your clients can usually wrap their heads around it as well because it's a very simple thing. You're saying effectively you're creating effectively your own dividend income stream. You could term it that way for your clients if it makes them easier for them to understand. Also, getting paid to work a limit sell order is another way to approach it. A great approach because it is so simple. It works with a position you already have, typically a long underlying position. And that's usually one of the easy pros of it. It's simple, it's easy to use, easy to understand. The downside of it is to be more effective of it. Of course, you have to do it a little bit more frequently. Some advisors like to set it and forget it. They do 6 months, 1 year calls, and that's really not maximizing the theta decay portion of it. You have to do it a little bit more frequently, usually in the monthlies, to really get the most bang for your buck. Weeklies, if you're super aggressive, but monthlies is usually where you probably want to hang out at the very least. Matt probably has some more data along those lines. And also the other con some people like to point out is that it can potentially clip the upside of your portfolio. So if you're doing this in an underlying where you have a very aggressive upside expectation, maybe you don't want to do it, or maybe you want to make sure your covered call reflects that, selling a pretty far out of the money type contract. So those are a few points to remember. We have more to discuss, but first I want to go around the horn, get everyone's thoughts. Maybe we'll start with the director of risk. Chris, you're out there. Obviously, the DRS known for its protective side. Obviously, you're buying the long-term puts, but your day-to-day is spent quite often actually managing the short end, the narrow duration, which is the short call and indeed the short put to finance that long put position. So you have a lot of experience on selling these covered calls. What are your thoughts on this very basic but still very popular and very effective way to harvest some income for a portfolio?
Yeah, I think you have to really define the objective with what you want. If you have a single stock portfolio and, like you said, you're okay taking assignment and you're trying to target a certain return, and that's great. You know, some of the challenges with selling calls, especially in index products, is the volatility is on the lower end because there is a lot of pressure. You have to be a little bit more tactical in managing that call in the index products because, the market movement over the last 10 years has been sell off 5 to 7%, and then 2 weeks later you recoup it completely. So that's really the challenge when you're selling calls. You don't want to get stuck or sell too prematurely. There is some small period where you've got a market movement or distance of movement, and there's still some volatility that you can harvest there. But I think it's more difficult to sell in calls in index products than it is in single stocks, just because of the way the volatility and pressure, on upside calls in index products. And interesting to note, when we broke down that Morningstar group, nearly half of all the ones that we put into the option income bucket, about half of them were just covered call portfolios. So there's definitely a lot of value in there, I think, but there's more value if you do the work going into single stocks and that kind of thing. I'm not saying that there isn't value with the index products. You just have to be a little bit more tactical.
Yeah, you got to work a little harder to squeeze that juice out in the index land. Matt, obviously, when you're not talking to us here on the show, you're doing back testing, also doing a little bit of the old RIA stuff yourself over there. So you have a lot of clients, I'm sure, approaching you, asking you about this exact position. I don't know where it ranks in your back test request, but I got to imagine it's pretty high up there. What are your thoughts on this effectively the gold standard for a lot of RIAs out there, the covered call? Maybe some of your thoughts on the pros and cons and things to remember when doing it.
Yeah, as Chris was saying, it's tough to do back tests or tough to come up with strategies when you've been in a 10-year bull market. So, we're doing a lot of looking at how these perform in various segments of that run up and looking at what are the goals and objectives and such. We have some clients that absolutely don't want to get called away. So those we're going to look at those call away rates and work on various ways to avoid those. And some of those ways are we're looking at conferences, like when they're speaking at conferences or investor days. We found that avoiding those helps. We also look at these are single stocks. When you have stocks that have gapped recently, one way or the other, avoiding those types of stocks, and then also avoiding earnings times. Those are ways to minimize the call away percentages, and then trading shorter duration, more out of the money. You don't get very much premium at all, but that's kind of the best premium, if that makes sense. So whereas you'll get a lot more if you sold more in the money and farther out, the most profitable premium, especially in these types of bullish markets, are the nearer terms. There's kind of a sweet spot right in there where there's some premium, but not as high as you'd probably think. So yeah, we've tested millions of overriding strategies, and again, as Chris says, you have to figure out what the point is of the client. Some clients want to have the selling of calls help cushions, if there's a drawdown. So obviously you'd want more premium there. Others just want pure income and not to be called away. So there's a balancing act, and it's a lot. There is a lot of technique to it, and a lot of different ways that you can look at it. We've found that the early exit really doesn't help that much, which kind of surprised me. I figured keep on it, but that they like to, again, the time right near expiration, getting those last few cents actually pay off in the back testing, which goes against my and probably as ex market makers, all of us probably goes against our intuition. But that's for this type of a trade, you need those expensive theta extra pennies at the end there. So those are just a few of the things that we found out, Mark, over the millions of tests that we've run.
That's why we like having you on, sir, because you bring the data to the table. But you point out what is often a sticking point for a lot of the asset managers out there. Because it's funny, for us, coming from the options world, you think you had a covered call, the stock gets called away, you hit the home run, you did it right. You hit everything that you wanted there on that trade. But for the RIA and for a lot of the clients, certainly maybe who have tax implications as a result, or they don't want to get rid of the stock for a variety of reasons, maybe they can't for some sort of corporate liability reasons. Either way, that becomes a scare factor for them. They don't want the stock to get called away. So as you pointed out, there's a lot of ways you could avoid that. That's certainly, if your clients have that concern, listeners, then you definitely want to establish your rule set at the outset for when and how you're going to address that. For example, maybe you go to selling vertical spreads instead of just doing the covered call by itself. Of course, a vertical spread, you sell one out-of-the-money call, then you buy a farther out-of-the-money call. So if the stock does run past it, effectively you have that spread in there to come in. Of course, the other way to do it is just to roll it, where effectively then you have to establish those rules very clearly at the outset. When are you going to roll? What percentage, maybe close to the strike, do you need to be before? What change in price maybe do you need to see before you decide to roll it? This is obviously something you want to establish ahead of time. You don't want to be scrambling to do it when the stock is racing towards the strike. That's not the time to try to figure out when you want to roll. Establish it ahead of time. Either roll or just close it out, but that's something you definitely want to establish ahead of time, and then you have that in place so you and your clients are happy with the results. And, there's a lot of ways you can augment this as well. Other ways you can get income covered call, like I said, is the gold standard for a lot of the reasons we all just outlined. There are other ways you can do it. I was joking earlier about RMC being kind of the mecca of selling puts, and glad to hear it's not the case anymore, by the way. But short puts are indeed still a very popular income strategy. Usually the use case is people use the short put as a way to open a long underlying position. It's not usually done in conjunction with a long underlying position, which is why it's not the most popular position for many of the asset managers and RIAs out there. Of course, a lot of them also forget, those who love covered calls and are terrified of short puts, they forget synthetically from a risk perspective, they are indeed the same thing. So if you're comfortable selling covered calls, you should be comfortable selling puts as well. Now, of course, the caveat being there, if you also have the stock, then you have to be comfortable with all the risks that are inherent there, where effectively selling this put now, you're effectively looking to get long more of whatever the underlying is that you're looking to get. That's why the short put is usually done as part of what's a popular trade called the wheel trade. Sell the short put if the stock drops. Of course, if it hits that strike and you get put, the underlying is put to you, then of course you can turn around, sell a covered call against it. Hence, you're wheeling in and wheeling out of the trade. A very popular two-legged income trade. A lot of our folks on the network like to use here. But in general, the short put can be used as an income trade in and of itself. It just has some of those caveats you need to be aware of, particularly if you already have the long underlying. Could be an equity, could be an index, could be a future. If you're selling a put below it, remember, you might be on the hook for buying more of it. Again, that could be what you want. At that lower price, you may want to average down, so that could be part of the deal. But in general, that's something you need to be aware of. Usually, it's done without the underlying. That's the way most of the asset managers and indeed the traders out there like to use it. But again, to each their own. And another one that's not quite as popular, it scares people quite a bit. You don't see a lot of data on it too, which is why it's interesting that the OIC actually did a study on this. And again, I wish Eric was here to talk about it, but we'll pull it up in his absence here. But it's got various different names. You can call it a covered strangle. Some people call it the covered combo. Either way, what it effectively is taking that covered call position. So you have the long equity position or a long index position, long underlying position, and then you're selling typically an out-of-the-money covered call against it. You understand that portion. And then you're adding another leg below the money now. So you're selling typically an out-of-the-money put or put spread against it as well. So now effectively you're selling two legs. You're combining the two positions we just talked about, the covered call and the short put, putting them into one position. Why is that good? Well, it doubles effectively, maybe not doubles, but it increases the amount of income you're generating from that trade. Instead of just selling the call leg, now you're selling the put leg as well. So you're going to see a boost. And typically in most equities and indices, the put's going to carry a lot more volatility premium, so you're going to get a lot more juice for that put than you will for a similar percentage out of the money call. It's just how skew works in most of the equity products out there. Of course, the downside of that, pun intended, is that, of course, if the stock drops or the underlying drops, you will indeed be picking up more of that underlying. So that's not something that's everyone is ready for. That's a little bit of a scary point. But some interesting data on this. The OIC did crunch the numbers. This study coming back in 2015, I believe, and they do call it the covered combination there. And they studied a bunch of different positions. And they found that most of them, in fact, all of them, I think that they studied, all of them combined some sort of income component. And this covered combo was the one that they found really, really stood out, outperforming the long equity, long index, whatever it was, long underlying by itself in terms of risk-adjusted performance and indeed in terms of overall performance as well. So that's one's a little scarier for people, but another way, particularly as you're getting into these challenging environments where rates are coming down, the traditional methods of income is a little bit scary, or I should say a little bit lacking, really. Then these are maybe some additional lengths you may have to or want to go to generate the income you want for your clients. Matt, I know these are alternative approaches you guys investigate all the time, whether it's the vertical, whether it's maybe the a little bit scarier, perhaps covered combo. What are your thoughts on some of these auxiliary ways, let's put them, to generate income?
Yeah, those always scare me. I mean, I hearken back to the floor days when we try to be at least flat units. You know, if you look carefully at Chris's slide at RMC, it shows that over 60% of the firms were net short units, meaning there's more short puts on the downside and more net short synthetic calls on the upside. So, the things that we are also doing, we didn't really, the verticals don't test very well, but the diagonals do better. So, for example, you might find a longer term way out of the money call to buy in a particular stock, and then you could sell shorter term closer to the money. So you still have that kind of protection of the smaller, more out of the money, but you don't have the same theta issues. So that's one way to kind of counteract just being short a call. And then on the downside, I don't like selling puts alone. So one of the tests that's been showing promise is the long 1, short 2, and then buying a longer term put. So like a 1x2. And that brings in, and you set up the back tester, and you set up and then our back tester then turns into a scanner. So you set it up to where you receive, a certain percentage consistently. So maybe that's 1%. When you get a long put that's closer to the money, and you're short 2 out of the money, and so you have some time there where you that long put might kick in even on the downside. And so it's almost like a broken wing butterfly that you're doing to finance that more out of the money put. So we're doing a lot of creative things. Our clients are doing a lot of creative things to pay for these hedges and to also offset this bull market effect on short calls. So there's some creative ways that you could do both of those types of strategies, Mark.
You mentioned paying for protection. I'd be remiss if I didn't also mention what is the holy grail, really, for advisors out there. Not particularly an income trade, but it has an income component. That's why I'm lumping it in here with the rest. It is, of course, the collar, which is, of course, selling that covered call and then using it to finance a portion of that protective put. I say a portion because typically any decent protection you're going to want to buy is going to cost a lot more than that call is going to generate for you. That's why there's been myriad studies on how to maybe keep rolling those covered calls and doing other things, doing a put spread versus a put, all sorts of ways we talked about many times here on the program to really try to pay for that put. In fact, so the collar, another one, not exactly an income trade, but it has an income component. And this environment, maybe you want some protection. Maybe you think these markets are heavy, but you want to use some income to help pay for that. So there's also an income component there to the collar. By the way, I did just pull up that study from the OIC. It is from 2015. They studied the covered call, protective put, collar, and covered combo across a broad spectrum of underlyings. They found of these 5 strategies, the covered combo outperformed the others using the 4 standard risk-adjusted performance measures of Sharpe ratio, Jensen's alpha, Trainer ratio, and the Sortino ratio. Again, that's not surprising. Some of these are going to be a little bit of a drag out there. Protective put, certainly not going to outperform. But in general, interesting stuff. I encourage you to find that study. Unfortunately, the link here is no longer working because they have indeed changed where files are on their website, updated the website since this is done. But if you go to optioneducation.org, you should be able to find it in their strategies and research section. And meanwhile, we have to keep on rolling because you guys keep deluging us with your questions. Let's see if we can get to some of them. It's time to open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. We did 2 special kind of summer mailbag paloozas the last couple of months because the mailbag was getting pretty full. And yet, your questions keep inundating us. Hey, we love it. Keep them coming. We love to hear from all of you. So maybe I'll have to do another mailbag palooza again. We'll see how many we can squeeze in today. Seems like everybody's got hedging on the brain these days. I wonder why that could be. Could it have something to do with where the market is right now? We shall see. Either way, the first up, we got PLC4 wants to know, is there such a thing as too much hedging? How many puts or how much of my portfolio should I allocate toward this strategy? And this is a perennial question here on the program. It comes in a variety of different flavors. What percentage of my portfolio should I allocate towards hedging? Where should I look at? How much should I spend? So it's a very frequent question. We understand your concerns because especially this time of year, this environment in the market, hedging is an interesting thing. Top of mind. Chris, you spend your days out there effectively finding ways to pay for that long-term put. What do you have to say here for Mr. or Mrs. PLC4? Want to know, is there such a thing, sir, at the end of the day? Is there such a thing as too much hedging?
Well, I'll answer it like this. I think if you're hedging any more than your notional value of your portfolio, then you're not hedging anymore. You're hedging anything above that is what I'm trying to say is that's probably spec or you're making a market call to the downside. At the end of the day, when you're hedging, you're trying to preserve this expected value. So you're trying to truncate drawdowns. You're trying to maximize the upside. And at the end, over a full market cycle, well, then you should have this preserved pot of gold in the form of your portfolio. So, hedging in a bull market is a drag. I mean, there's no question about that. It sometimes can be difficult to pay for. But again, if you're hedging more than what the notional value is, I would say that is too much hedging. But it depends on the risk reward and what you're trying to set up versus what you're trying to protect on the downside versus what you may give up on the upside.
Yeah, if you're like 3-to-1 puts versus underlying in your portfolio, then you're not hedging anymore. You got a whole new thing going on over there, which is nothing to do with your original goals of your portfolio. What about you, Matt? I'm sure you've had variations on this question. Is there such a thing as too much hedging? And the perennial question, how much or how many puts really should they be putting on?
It's a good question, actually, because we've been doing a lot more of this because we and I think Chris does too, and so does SWAN. The way out of the money longer term puts are the ones that kind of preserve the, they don't have as much theta and they stay there and they tend to, since they do have some vega to them, they tend to pop, but they don't pop that much and there's no gamma to them. So that's kind of the issue. So what we've been testing more now is over hedging those. Maybe you do 3x or 4x of those puts, along with, like I said, an income producing type of shorter term strategy, like a vertical or a 1/2 ratio that is done for a credit. But so in that case, you're over hedging, notionally, so to speak, but you're really not because it really depends on the delta. So I guess my answer to that is like so many things, what is your purpose of it? And then you should try to, instead of just looking at the number of puts, which is what the question says, you look at the effect of a market going down a certain amount and use these what are called slides where you visualize the market going down and what's going to happen to implied volatility and value your positions at that point and see what, how much you make versus how much you're spending, Mark.
I was just joking about the 3x. It sounds like you're actually back testing that, which is kind of interesting, and in the longer term perspective. So interesting, fascinating stuff. So that's why we like having Matt on here. He's bringing all sorts of new angles to the question. Speaking of bringing new angles, let's close it out on this one from Eli Wave, bringing a different perspective on the hedging question. He wants to know, what are your opinions of binary options as a viable hedging or speculative vehicle against client long equity portfolios? If you're not familiar, listeners, of course, binary options, usually very short-dated options, not a lot of binaries that go for a long amount of time. Usually those things are playing in the sub 1 day spectrum, a few minutes, maybe a few hours around a particular event. Could be an earnings announcement, could be, some sort of crop report or OPEC meeting, something along those lines. There's usually a very short duration type contracts. Also, as their name binary implies, they're effectively 0 to 100. So that contract's going to be, by the time when that event happens, it's going to be worthless or it's going to be worth its full value, 100. There's no intermediary. And it depends on the venue where you trade them, what goes on in between. Can you trade them? If you are going to trade these things, the one kind of regulated outlet that we know of, and the fact they're right here down the street, the binary space has gotten very polluted with a lot of shady operators over the years. In fact, there's a reason why major platforms like Facebook and Google and others won't allow binary options ads anymore, because it is indeed such a haven for scammers. If you are going to look at one platform, and again, we don't have any relationship with them, we just like these guys, they're right down the street, is Nadex, because they actually have regulatory oversight, they have compliance, they exist. I can see the building, I can see the people I know. They're not gonna vanish overnight. So that at least puts aside one concern, and that products there will trade from 0 to 100, and 0 being effectively it works on percentages or cents. So if you think a product there has, if it has a 75% chance of expiring in the money effectively, it'll be trading at a 75. So that's a little bit more intuitive way to go about it. But again, these are very short, and they'll even tell you they're an ADEX. These are short duration products. These are not typically used for hedging in the normal sense. They're used for, if you want to use them for hedging, for very specific events. I will say this before I toss to you guys. There is one use case I've seen that's kind of interesting. It's on the commodity side, and it's in particular with the Nadex contracts, as they have a lot of agricultural and commodity type things, is we have seen some people on the futures option side of the fence who are maybe selling premium and looking to harvest the old risk premium around certain events like a crop report or other things, and they're worried about what's going to happen during that event. So maybe they want to hedge, but they just want to hedge for that event. They don't want to, let's say, buy a weekly or a monthly contract with all of the other inherent Greeks that are involved in that just to hedge the risk around this one, couple of minutes worth of an event. So we have seen some use cases where people will be selling, let's say, straddles or strangles or other short premium type positions, and then they'll buy binaries on the wings because they're cheaper, and that will give them a little bit of a hedge for what they're looking for. So that is a unique use case for hedging that I have seen from binaries, but for the traditional, long portfolio looking to ride up a bull market and looking to hedge it with binaries, I don't see a lot of that use case. So let's go back around the horn. Chris, have you explored the binary world does this even come on your radar over there while you're slinging 2-year puts, sir?
No, it certainly does not. I mean, these things are going to be all or nothing. So I think their use is definitely for a short-term event. And if you have a lot of risk on, and I think you hit the nail right on the head as far as if you're selling premium and you're worried about some type of event, then yeah, there's definitely a use case for these, under that kind of scenario.
Well, unfortunately, I still got a ton of questions, but unfortunately that music means we've come to the end. What an epic sojourn through the world of options it was today. We talked all things European risk management, us American Delta Cowboys and our naked Deltas. We talked about the earnings season, what a crazy one it was. We talked about some ways with the Fed cuts still ongoing, how you can maybe wring some additional income out of your portfolio, and we wrapped it up talking hedging, paying for hedging, how much hedging is too much, and of course, binary hedging, which is an interesting one. If you have an interesting question like that, you want to hit us up, you know how to find us at Options on most of the major social media platforms, the website, theoptionsinsider.com, or use our mobile app, or the old-fashioned way, questions at theoptionsinsider.com, even send a carrier pigeon. It all gets to us here at the end of the day. You can also hit up these guys in between shows at SWAN Global on the Twitters for Chris and the team over there at SWAN, and of course at Option Rats, easy to remember handle for Mr. Matt. Before we go, let's go back around the horn. Let's start with Matt. Matt, you just talked earnings season. You said how exhausted you were, but it's starting up again pretty soon, so take that nap now. But in addition to the earnings season reports, what else can they find over there in the land of ORATs, sir?
Yeah, we're always bringing new stuff. We're adding technical indicators to our back testing and our scanner. And we're also introducing at London event, Battlefin, our new data set where we have component-weighted volatility metrics going back to 2007. So it's pretty interesting, actually, to see the implied correlations embedded in those types of calculations. So it was pretty interesting, and I invited one of my clients who was from Munich, and he goes, Munich is much better this time of beer. So I thought of Chris when he said that.
Yes, sounds about right. Battlefin, I like the name. I've never been to the event, but I do like the name. Interesting. Looks like it's very much a data-oriented event. I'll have to let us know, have to keep us abreast on the next show, Matt, how all that went. And of course, if you're looking for some hedging, some protection, or maybe you want to learn how you could utilize these options things, maybe you want to attend an event of your own while in between these fun episodes here, of the advisor's option. Chris, what's cooking in the land of SWAN that may interest them, sir?
Well, we've got that piece that was put out recently by Mark Otto, the bleak future of bonds, about how bond risks threaten traditional portfolio construction. You can also check out all the other great content that we have at swanglobalinvestments.com.
Yeah, I encourage you to check it out. Actually, some great content there. Mark Odo, Micah, the team, research team, doing great stuff over there on the blog. You have the newsletter, the good, the bad, and the ugly. Of course, you can always find this fine radio program up there as well. Swan Global Investments, good place to go for content in between our episodes. And speaking of content, like I mentioned, our friends over there at OIC, optionseducation.org, good place to go for content as well. Newly revamped website over there as well. A lot of great data. All those studies, I'm always referencing a lot of them coming from those folks. If you want to arm yourself with some data, in addition to what Matt's always talking about back testing, maybe you want to have some broad-reaching studies, optionseducation.org is the place to go. And on behalf of Matt and the Director of Risk, and even our buddy Eric who's out there traveling hither and yon, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many questions. We love them all. Keep them coming. We love to hear from you guys. And we'll see you back here next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.